Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today, we are diving into a report from the Federal Home Loan Bank of New York. Get ready, because we are about to uncover some financial moves that could impact, well, just about anyone who relies on a stable housing market. It might sound boring, but trust me, there's a reason this information is public and required by the SEC. And before we dive in, if you like getting clear explanations of confusing corporate documents, make sure to subscribe. We also have a Discord community linked in the description below, where you can chat with other folks interested in finance. So this report is a heads up about some new debt that the Federal Home Loan Bank of New York is taking on. This debt, called consolidated obligations, is basically how the bank funds its operations. It is a fancy name for debt, and it allows the bank to buy mortgages from local banks, which keeps the housing market moving. Now, it is important to remember that this debt is not backed by the government, but by the financial health of the 11 federal home loan banks. This report focuses on something called a direct financial obligation. Simply put, it is all about debt. The Federal Home Loan Bank of New York gets most of its money from selling debt securities. These securities, called consolidated obligations, are basically promises to pay back money with interest. Think of it like a giant IOU. The interesting thing is all 11 Federal Home Loan Banks are responsible for this debt, not just the New York branch. These banks are overseen by the Federal Housing Finance Agency, or the Finance Agency. The Finance Agency can make any of these banks pay back the debt of another. In other words, if one bank is struggling, the Finance Agency can tap the others to cover the bill. This debt is sold to the public through authorized dealers. It is important to remember that this debt is not backed by the United States government. The risk falls on the Federal Home Loan Banks alone. Schedule A of this report lists all the bonds and short-term debt that the Federal Home Loan Banks plan to issue. The New York branch is primarily responsible for paying these back. It also includes any debt that the New York bank has taken over from other Federal Home Loan Banks. It is important to keep a few things in mind when looking at the numbers. First, the report mentions that while the amount of debt issued is important to the bank, they are not saying that any single bond or debt is particularly important. Second, the numbers do not include interest rate agreements, which can affect the actual cost of the debt. Third, the report does not show the total amount of debt outstanding. It only shows the new debt being issued. The bank will report the total debt in its regular reports. Finally, the amounts listed are the face value of the bonds, which may not be the same as the amounts reported in the bank's financial statements. This is because of discounts, premiums, and other fees. Let's take a moment to talk more about that Schedule A. Again, in simple terms, the numbers you see there are the amounts the bank promises to pay back, not necessarily the actual money they received when they issued the debt. The bank might have sold these bonds at a discount to attract buyers, or they might have added fees. These factors can make the real cost of borrowing different from the face value. I'll talk right to the actual schedule. Here we have Schedule A, which holds the numbers we've been waiting for. It contains information pertaining to consolidated obligations. And unfortunately, Schedule A is not included in this document, so we cannot look at the specifics of their financial obligations. This report was signed off on May 6, 2025 by Benjamin Tan, Assistant Treasurer. Let's zoom out and talk about what all this means. The Federal Home Loan Banks play a critical role in the housing market. They provide funding to local banks, which in turn lend money to people buying homes. By issuing debt, these banks ensure that there's enough money flowing through the system. Here's my take. The Federal Home Loan Bank of New York is taking on more debt. That's not necessarily a bad thing. It could mean they're expecting the housing market to grow. However, it also means they're taking on more risk. Remember, this debt is not backed by the government. If the housing market falters, the bank could struggle to repay its obligations. One thing to keep in mind is that the interconnectedness of the 11 Federal Home Loan Banks creates both strength and weakness. If one bank runs into trouble, the others are obligated to help. But this also means that problems can spread quickly throughout the system. Overall, the Federal Home Loan Bank of New York seems to be moving forward confidently. They are taking on more debt to support the housing market. However, it is always worth keeping an eye on their debt levels and the overall health of the housing market to ensure that they can meet their obligations. Alright, that's our breakdown of this report. What do you think of these financial moves? Are they a sign of confidence in the housing market or a cause for concern? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.